Major funding for these broadcasts has been provided by grants from New York Community Bank, Capital One Bank, Eastern Consolidated, M&T Bank, Sterling National Bank, Meridian Capital Group, Customers Bank, Ariel Property Advisors, Dime Community Bank, Perfect Building Maintenance. Additional funding has been provided by AKA Hotels Corman Communities, AmTrust Title Insurance Company, AVR Realty Company, Avison Young, Bank of America, Merrill Lynch, Bank Leumi USA, Briarwood Organization, CBRE, Chase Commercial Term Lending, Chase Mortgage Lending, JP Morgan Chase, Citizens Bank, Cohen Equities, Colliers International NYC, Collins Building Services, Connect One Bank, CPEX Real Estate Services, Douglaston Development, Levine Builders, Flushing Bank, Friedman LLP, Handler Real Estate Organization, Handro Properties, Hodges Ward Elliott, Inc., Investors Bank, James D. Kuhn Real Estate Center at Syracuse University, Kilroy Architectural Windows, Madison Realty Capital, Matone Group, Mercantile Bank, New Banks, Newmark Knight Frank, Optimum Window Manufacturing Corp., People's United Bank, Pulcinelli, Rockefeller Group, Rosewood Realty Services, SJP Properties, Stonehenge Partners, TD Bank, Terra CRG, the Knackle Group at Cushman and Wakefield, the Meringoff Family Foundation, the Moynihan Group, and these friends.
So the question is, how's the investment sales market doing? Is it great? Is it weak? I don't know. So I've assembled this group of 4 individuals or business leaders to provide their insight on how the investment sales in the New York market is doing. My guests today include Will Silverman, who is the managing director at Hodges Ward Elliott. David Schechtman, who has this unique title, Executive Managing Director at Meridian Investment Sales. Shimon Shkury, who's simply the president and founder of Ariel Property Advisors. And another short guy on the other side of me, by the name of Ron Solarz, who's an Executive Managing Director and a principal at Eastern Consolidated. So since we know you're a little shy and you don't like talking, how is the investment sales? You know, what's really happening in the market? We're not $1 million listing.
In the $1 to $150 million range, the market is spotty. Deals that you wouldn't think would sign and go hard are, and then deals that seemingly, with cap rate expansion, should sell are sitting on the shelf. It is the most difficult market since 2009, but it's still a market that I would take every year for the rest of my career.
So are you going to go back to practice law?
You couldn't pay me. I'm not smart enough. I leave that to the several hundred lawyers who really dominate the real estate transactional market. But Michael, the quick answer is when you're traveling at 80 miles an hour and you slow down to 45 miles an hour, you almost want to pound the steering wheel of frustration. But the truth is you're still moving and you're still going to get there at a great clip. Everybody's earning money.
Shimon.
Well, let's talk about numbers. I mean, the first 6 months of the year, in terms of volume of transactions, has been extremely slow. I mean, we saw about $16 billion of investment sales trades throughout all 5 boroughs. If you annualize that, you're back to 2012, 2013. And if you look at pricing, which is really interesting, you don't see much fluctuation. You see that the multifamily market, for example, has gone up in every single sub-market with one exception, which is Brooklyn. Part of the reason is Brooklyn last year had a lot of the brand new buildings sold, and so they helped pricing. If you look at land have gone down in pretty much every sub-market, but again, it's 5%, it's 7%. It's not a dramatic shift in pricing. So the first 6 months of the year have been extremely slow from a transaction perspective. June has been good. There's expectation that the second half of the year will be pretty good in terms of volume and velocity.
Ron, you've had a pretty good couple of months, and you had the multifamily, large multifamily, 14 buildings or something like that?
13 buildings in Inwood, 64 million.
Right, over there. Then you had the deal with the Rockefeller Group, the assemblage in Nomad.
That was 100 million.
Right. And you've had some retail, so it doesn't sound like the business is as bad as Mr. Schechtman is alluding to us.
For me personally, it's been incredibly busy.
How about the rest of the guys in the shop?
It is slower. I mean, I don't have the exact percentage. I love the metrics, but I think in general it's been slower. My sense is I've been working mostly on multifamily transactions. Demand seems to be incredibly strong. Demand is definitely greater than supply, and cap rates for multifamily, especially with upside.
You bring up something, and then I'm going to go to Will for a second. Multifamily is still the chosen asset class that people like. Has there been any effect, basically, on the prosecution of Croman because of what he was doing with pushing tenants out, having an effect on the multifamily of certain other people? Do you see that?
I didn't. I mean, the demand for multifamily, as everybody here alluded to, is extremely strong. It's harder in terms of debt and lending. That environment has been extremely tough, even for multifamily, but the equity is there to buy.
You recently traded this building. What's the building on 27th Street?
31 West 27th Street.
5 times in how many years?
Now, the building sold 5 times in about a 10-year period. I worked on the sale of it 3 times in the last 5 years.
Do you see the price going up again?
I do. I think, I echo David's comment, and the way I like to phrase it is, it feels like today, in any given deal, you either have a frenzy or crickets and very little in between. What the market loves, it really loves, and what it does not love, in a hurry. And I think what the market loved about that particular building, which is half a block from the Nomad and has a Soul Cycle across the street and is in a very exciting location, is that I think a lot of people said, where I think that neighborhood is going in the next 5 to 10 years is probably better than what I would ever say out loud or write on paper, and I want to be there to ride that wave as that happens, because the story for that market and that block going forward.
So why don't we get to the subject of neighborhoods? Okay, where are things going? I know David recently has a deal, commercial condominiums in downtown Brooklyn. That's one market. Shimon, you had a luxury townhouse, near St. Patrick's, and you have a lot of properties up in Harlem and other places that you've been doing other deals. You've had, a combination of things. What neighborhoods are there? Is the Bronx doing as well as everybody perceives, or is it more hype than it is?
Depends on where you are in the Bronx. We sold a portfolio of 1,000 units there last year, and of the things we've sold in the last couple of years, it's probably the deal on which the buyer is performing the best. And one of my partners has a great phrase about this. He worked on and off in asset management in the Bronx over about a 10 to 15 year period, and he said when he started working in the Bronx, when you called a leasing office, the first thing they would say to you is, are you working or are you on a program? Because so many of the tenants were. He said, now when you call a leasing office, it's, are you interested in a 1-bedroom or a 2-bedroom? And I think what's happened in the Bronx is that we've had gentrification of so many neighborhoods around the city that as different neighborhoods gentrify, the last place that's affordable for not the gentrifiers, but the gentrifiees, the people who are displaced by the gentrification, is the Bronx. And so whether the gentrification happens in Bushwick or Prospect Lefferts Gardens or Upper Manhattan, wherever it happens, it's all more demand for the Bronx. So it's like the old joke of, in a gold rush, do you want to be one of the guys panning for gold, or do you want to be the guy selling shovels? In the Bronx, you're the guy selling shovels.
I want to echo that. And I think from an investment perspective, if you look at the Bronx, you see that this is the borough that kept the volume up, and pricing is about 7% higher than last year. And if you look at the metrics, you see that it's close to sub 5% on a cap rate basis, about 12.5 multiple, closer to $200 a foot.
Here's my question, and it relates to the neighborhoods we'll get back to. Foreign investors have continued to come into the market. You've been quoted, all of you have been quoted about foreign investors. Are foreign investors interested in the Bronx?
Yes, without a doubt.
I'm marketing currently a 6-building portfolio in the High Bridge section of the Bronx, 263 units, and we're very close to signing a contract. Some of the bidders were locals backed by capital that was not domestic.
I'm finding the same thing. I'm surprised because historically, when you have people coming in from whatever country it is, they want visible, they want glossy, and things that will have name recognition, whether it's Madison Avenue or Soho. If they went to Brooklyn, it would be 6 or 7 streets. The Bronx would it would have to be a massive transaction like infrastructure or industrial. We have a $11 million warehouse in the Hunts Point section of the Bronx. The foreigners are beating out the locals, and when I've asked some of them, what do you intend to do with it? This is a real bid. Their answer is, we're buying this on a per pound basis because of belief in continued growth. It goes directly to Will's point.
Okay, you bring up an interesting topic on the industrial. In my honest opinion, everybody, when you take an industrial property and you believe you can convert it to office, have we reached the number? Because a lot of the new conversions are not doing as well. They're not leasing over there.
They're failing. And it's not just, I think it's more specifically in Brooklyn. I think the idea, part of it is the Google syndrome and the food hall syndrome. Hey, I have a cavernous space 5 blocks from the subway, which is close enough for a millennial. Why don't I gut it, make it into white space, put some concrete and some LED lighting. I'll bring in some food halls. We'll have some $22 pretzel sandwiches with tofu on them. And we'll have some tech company, and hopefully Google will come in. You're going to start seeing some failure there, and I predict that you're going to have those spaces repurposed again back to straight office, light manufacturing, assembly, and industrial again.
I think the trendy trade right now is if another investor calls us and says, we're beginning our exploration of the last mile distribution business, or we want to get smart on industrial, because again, it's sort of analogous to the Bronx thing. Every industrial building that gets converted to office is pushing a former industrial tenant somewhere else.
Right, and there's limited number of industrial spaces. And
yeah,
and I believe,
and very few ones getting built.
Okay, I believe there's more need for industrial than this, this conversion into the office. Because what happens is now you're taking the industrial space and they're saying, oh, it's a 28% loss factor also for the situation. With regard to that, how do investors look at the situation with regard to co-working?
Before co-working, you were talking about the availability of industrial buildings. You have to remember that in the past 10 years, about 11 million square feet of industrial space was converted or rezoned, and mostly to residential. So that was taken out of the market. And because of that, you see that the demand for it, when it exists, is a lot higher, and the supply is tighter.
Right, but that's an industrial. But what about co-working space? Because, you read everything that, WeWork is opening up in the Brooklyn Navy Yard, okay? Mm-hmm. They want, Rudin wants $80 a foot, $75 a foot. There's a question. There are a number of companies, but a couple of the co-working have been hurt. If you have a co-working tenant, how are the investors looking at that?
I think people are coming around to it. I think where we're going to head is that WeWork will be one of several flags that offers a particular brand of office experience.
They'll be like the
tenants.
Regis in this circle.
No, forget that's.
Regis is dead, you believe?
I think Regis is boring and unexciting. I think WeWork is interesting and fun. But Michael, I think the larger point is that the convergence is between office becoming a hospitality business, and WeWork, I think, alerted everyone to that. And the other question gets back to supply and demand. At the beginning of our careers, who remembers the first time you walked into the Lincoln Building and there were 35 tenants on the floor, or the Channon building, or the Empire State building,
200 tenants on a floor.
or any one of the buildings that at some point in the last 15 years hired Billy Cohen to pursue a full floor strategy, right? So has anybody invented a new building that's catering to 500-foot tenants? So what WeWork was arising at the same time as every landlord who could was pushing out that size of tenant. So they're meeting a portion of demand, and what they've done is, if it used to be, let's say here is Guy in his garage and here is General Electric on the scale of corporate sophistication, it used to be that from this stage in your life to about here, you could survive without having real office space. What WeWork has done is let you get to about here. So they've broadened the audience of people that might potentially be interested, which is why they're getting corporate users. I was in Hong Kong. One of their spaces had 300 HSBC desks in it. Right, that's who
Right,
the customer
that's
base
called
is.
the enterprise program
Right.
at WeWork. What about with regard to retail? I noticed that you're selling something for Toll Brothers and some other things, the retail in the office, but in the residential towers. How's retail selling doing? Because everybody is saying the demise of retail, e-commerce is killing it, but I still see retail opening.
So buyers would prefer to buy occupied lease space, and I would say the cap rates they would require would be 5 cap or greater generally, unless it's something very unique. There's a lot of upside, or it's a super high quality tenant. Vacant retail is getting a lot tougher. They're plugging in their underwriting, longer lead time, etc. Vacant retail is tough. It's not easy.
But what you're seeing is you're seeing repurposing. People have talked about the demise of retail. More intelligent articles and commentators talk about the evolution of retail.
I don't know which one you're putting me into the category.
Well, I'm here, so it's the latter. We're marketing 5 garages on the Upper West Side of Manhattan. It's 240,000 gross square feet. The strike price is about $200 a foot. I will tell you that the lion's share of the top bidders for this property are not garage users. This space potentially lends itself to other uses, and that's analogous to what I'm seeing, and I think my colleagues are seeing in other retail spaces.
I know that, Will, you had a number of retail spots that you were marketing.
Yeah, I mean, I think the thing, one of the guys that bought a retail deal from us has this great saying, which is no vent, no rent. And what they're alluding to is the popularity of fast casual dining and the way that you can lease spaces that are oriented that way. But I think what we have in New York is as much a supply problem as an internet problem. So I know Shimon likes stats. This is an interesting one. So you know the Rebney report that comes out every half a year on the different retail corridors? Sure. So we looked at how many corridors Rebney used to think it was worth reporting about, meaning they were like relevant to big tenants 15 years ago, and how much linear frontage that was, and how many corridors are on that list today. And it's gone from about 38,000 linear feet to 58,000. So we've effectively added 4 miles of relevant frontage in New York City. And think about tenants. Think about Brunello Cucinelli, right? The store I aspire to one day be able to afford to shop in. They're on Madison Avenue, they're on Bleecker Street, and on Green Street. 15 years ago, a tenant like that would have only been on Madison. So I think what happened is we expanded the relevant supply way faster than we expanded the number of tenants. And I think the real question is, for high quality real estate, where is it still going to be wet when the water recedes? And I think that for a lot of buyers are thinking, there's a lot of downward pressure on retail right now. It might be a good moment to buy super high quality stuff because the tenants will still be there for that.
Which goes back to the price per pound argument. When I tell people, look, I've got garages, they're $200 a foot for 250,000 square feet, they're going to hold them, the warehouse in the Bronx. But more importantly, we're advising co-ops and condos in some limited instances to change use, to allow not for vented cooking, which could be the death knell for a resale of a high-end condominium anywhere on the island of Manhattan or Brooklyn or other places, but to start getting a little bit more permissive in their uses and start thinking outside the box. Ground floor retail in a trendy condominium on a side street heading toward Hudson Yards or saying in Chelsea, what about allowing for co-working space on the ground floor at a lower price per foot because you're on a side street? If you can get that retail space in a 50-footer for $58 a foot, Heck, the co-working space will give you $90 a foot because their net effective rent is higher. So it's evolution, and there's going to be a lag as we evolve.
And they'll rent on an office loss factor.
That's right.
Now, what about land? Okay, you know, land wasn't trading that much. The 421A rules are around there. People understand it a little better. Do we see land trading?
We do. We recently went to contract on a 223,000 square foot site on 96th and Broadway. Actually, Brian Azrani was leading the charge on that one. And that deal, the blended number, it's in contract, but it was public already. It was $500 a foot. And then we talked about the Rockefeller Group, which was $580 a foot. So what I'm seeing is there's demand, and I'm also seeing that land costs, you know, let's say on average went down about 25%. And as sellers, you know, accept these lower values, and assuming there's sites available to sell, those sites are trading probably in the $500 to $600 a foot range.
In Manhattan, below 96, anything that's priced around $650 or below will receive a lot of activity.
What about Brooklyn and Queens on land?
Brooklyn went down about 10% year over year. I don't know 25, but year over year 10%. If you have condominium land that could lend itself to condominiums, it'll be taken by developers. Brooklyn today has a lot of rental apartment buildings coming on the market, but has a shortage of condominium units.
Same for Queens. I'm seeing a premium because they're oftentimes in the prime areas, the Forest Hills, the close to Kew Gardens. We're still seeing a real premium there. And we're talking about sites that are generally no greater than 100,000 square feet because it doesn't lend itself to that. We're still pleased that we'll be scraping the 400 or 500.
What about our fifth borough that people don't talk about too much? I believe you people were responsible recently of selling something in Staten Island, okay? You know, what's happening in Staten Island? I mean, will foreign investors are positive about the Empire Outlets and the Wheel? Or, I mean...
You really must not like me. You're setting me up. You know, woe be unto the person who says something negative about any of the 5 boroughs. Staten Island is terrific. It's wonderful. It's transportation challenged. Therefore, like you said, it will always be the 5th borough. We solve transportation, prices go up.
Bridges take time. You know, they have 2 bridges. One is to Brooklyn, one is to New Jersey.
One is $17. $17.
Only one way, though.
There's the escape.
You have to pay to get out, but it's free to go in.
That's right.
So have you done anything in the 5th borough?
I have not, although I do find it incredibly fascinating that the Outer Bridge crossing is named actually after a guy named Outer Bridge.
In 2014, we sold an apartment building there for less than $20 million, and the Real Deal put us as the #1 broker for Staten Island. So.
And you've had 7 calls on that since then, 5 years.
Now, you know, you live in Westchester, you live in Connecticut, you're a Brooklyn boy at least, and you're a Manhattan boy. What's going on, you know, in the Westchester, Connecticut market?
I think, you know,
I mean, Stanford, they gave in last rites because of the office space over there.
I think eventually the suburbs come back, and it's all demographics, right? So at the height of the baby boom and the height of millennials, there was about 4.25 million people born per year in this country. At the time when I was born, in the mid to late 1970s, there was about 3 million people born, which is how I got into college. And that explains a lot of things, because right now the reason suburban home prices are down is because the 4 million people a year born in the baby boom are trying to sell their houses to the 3 million people a year born in the 70s. What's going to happen on the upswing is, I think, a lot of the millennials, some of them will stay, but some of them will have their second child, they'll do the math, and they'll decide to decamp for the suburbs. This is where I think RXR's strategy is brilliant. They'll decamp for the suburbs, but not the ones that we might have looked at. They'll want a sort of Bethesda-style experience, a walkable community with a good commute.
That's perfect. I call it the urbanification of the suburbs.
Absolutely right.
If you look at the Ossonings, the river towns in Westchester, they're hipper. They're hipper than parts of the city.
That's why you don't live there.
Well, I am a plain vanilla minivan driver, as you well know. I have a Metro card and a minivan. But the urbanification of the suburbs to try to preserve the populace that's there now is working in part.
Now, here's something, since I am the baby boomer amongst you, I believe that one of the opportunities for a a developer today is in the assisted living, and I know that Eastern sold a site on 56th and Lexington, and then there's another site being built
I did that
on another one on 92nd and 2nd.
And West End for 151 million that my partner did.
Right, but what I'm saying to you is that was an existing.
That's right. And it's going to remain that way
right.
instead of being high-end condos.
Right, but what's happening is there is such a need, and people want to have their families to remain in the city. They want to be over here. Even when you guys are selling land, I think that is a market that you should be looking at as a possibility, because those are the people who can afford to pay rent, even if the land costs $500 a foot, because they're going to charge that type of money.
They've been waiting for the barrier to entry. I think it's analogous also to the student housing and elder care and senior housing. I think those are two groups that really couldn't break the barrier when lands were at their zenith. Now that they've come down 10, 20%, some places 25%, and it's still a high price relative to a 15-year, taking a look at it over 15 years. Now you're going to see a lot more strikes. I couldn't agree more.
Shimon?
I think that's something definitely to look at. But again, going back to the highest and best, if it's in Manhattan and the highest and best is going to be selling condos at $3,000 a foot, it's going to be hard to beat.
You know, an interesting side note, the deal that Hines did at 56 in Lexington, we had about 12 offers, and most of the bidders were condo buyers. Hines beat them out, and they're going to do assisted living. They paid $1,043 a foot, which was a big number, but it was the perfect location.
I mean, to have an assisted living right off 57th Street, right in Midtown, this is a prime location, and I believe that they will get the highest rate for an assisted living room over there.
Absolutely.
With a couple of minutes left, where are the greatest opportunities? People always come ask me, where are the opportunities? Where do you see the opportunities? Is it in Inwood? Is it in East New York? Is it in the Rockaways? I mean, now that you have ferries over there, where do you see this?
I think Washington Heights is one of the areas that appreciated the most and will keep appreciating as a result of being a part of Northern Manhattan, and part that didn't appreciate over the past year or so, and we're just seeing it. So that's one area that I'd look at.
Ron, what do you see?
I like Harlem. I like Washington Heights. I like Inwood.
Okay,
I like the Bronx.
When we talk about Harlem,
yes,
there's East Harlem, the Central, and West.
Both. I mean, right now I'm working on a Harlem deal. Demand is extremely strong.
I like multifamily across the board. There are fewer rental units in New York City today than there were in 1980. It's the only product type you can buy where the supply contracts the hotter the market gets. And anytime you can buy multifamily without having to underwrite a rent spike, you're likely to outperform your underwriting.
Mr. Schechtman?
I agree with the multifamily, but I think in all sectors, I think the place to focus is on a price per pound basis. If you can get a large building that in some way can be repurposed for more than one use, and your price per pound makes sense or is historically at least on the low to normal side, I also think that what we have to realize in New York is every asset class, including vacant retail, is valuable if you can hold it for more than 3 to 5 years.
Okay, so in summation, the world is not dying. The investment world continues to be there. There are still opportunities for investors. Things are going to take place, and I don't have to make a collection plate for the 4 of you, I hope. Okay? So I'd like to thank my friend Will, David, Shimon, and Ron, and I'll see you next week.